A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older, and its unique features make the HECM a valuable tool in retirement planning and aging in place. Did you know you can actually buy a home with a HECM and get all the same advantages and features of a regular mortgage and a lot more besides? Well, you can. We're going to review this flexible product and a few circumstances in which we think it can help. A HECM for purchase, or what we refer to as an H4P, can be used to buy your dream home, whether that dream home is larger or smaller than the home you currently have. Basically, we take the equity in your existing home or cash that you have on hand, we add it to a HECM for purchase mortgage, and this should give you the home that you want so that you can age in place in the environment you're seeking. The best way to explain the program is to take two examples. Let's say you have an existing home and you sell it for $400,000 net cash, and you decide to downsize. You find a new home for $300,000, you use $150,000 as down payment, and you finance the balance with a HECM for $150,000. You've ended up with a smaller, less expensive home, hopefully one more suitable to aging in place, with an optional mortgage repayment and $250,000 in the bank. The next example, let's assume you upsize. You find a new home for $700,000. You can use $350,000 as the down payment, and in this case, you can finance $350,000 with a new HECM. You've ended up with your dream home, you've got an optional mortgage repayment, and you've got $50,000 in the bank. So what are the advantages or disadvantages of a HECM for purchase over an all-cash or a finance with a traditional forward mortgage? An all-cash deal means you own the home with no debt, but it does mean all your money is tied up in the home, and unless you plan to sell the home, it's not earning a return. For a traditional forward government mortgage, down payments can be less, though for conventional mortgages they can be as high as 40% for older borrowers. But you have the advantage: you build equities, you pay off the mortgage. The disadvantage, of course, is that you have to make the payments and you need lots of current income. And you cannot use the dissipation of savings as income, but only the return on those savings. And you will need a decent credit score. While the HECM may require higher down payments and will cost more due to the economic features of non-recourse and optional monthly payments, you don't have to make that monthly payment if you don't want, so your monthly cash flow can be increased. There is no minimum credit score required, and the required monthly income is much, much lower. And on top of that, you may spread or dissipate your savings across your remaining life to meet that minimum income requirement. The one thing to remember here is that on new construction, you must have a certificate of occupancy before a lender can take a HECM application, though a buyer, of course, can obtain a HECM for purchase pre-approval. Also remember this: seller concessions are a special matter. In general, whatever is permitted locally for forward FHA mortgages will also be allowed for HECM for purchase. However, the HUD offices regionally do vary, and so if you have concessions from your seller, you will have to check with the local office and your local lender to make certain that your contract is compliant. If you're buying a residence using an H4P, there are some very specific things that must be included in the contract. It should include the FHA mandatory clause and the real estate certification. If you are not familiar with this, you should ask your real estate broker and they will explain. There are very specific rules about concessions and rent back options and credits. And there are rules about commission. And there are also rules about what monetary value should be included in the final purchase price. But the most important rule is to understand that the seller must pay for and complete all repairs. You cannot buy a piece of property using an H4P with a holdback for repairs. They must be completed by the seller before the transaction is finished, and you are not, as a buyer, to be completing any necessary repairs after you bought the home. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.